In a study done by James Sandage in 2019 called Chaos and Retirement Income, we show probably the biggest mistake made when designing retirement income strategies is assuming the rules you followed during the accumulation stage when you're trying to build wealth will work during the distribution stage when you want that wealth to create income to live on in retirement. Hello, Kurt Jackson, KJ Financial, with a quick analysis of Sandage's findings in an effort to help ensure your retirement is everything you want it to be without worrying about whether or not you may outlive your money. So when you're accumulating wealth for retirement and you are following the put your money in the market, leave it in during good times and bad because over time the market is always up, it means that your money is moving upward in an upward sloping line or linearly. Over time it does that, right? It's going to have some ups and downs, but over time it moves pretty much upwards, where what you put in is fairly proportional to what you grow. So if you had $100,000 in the market, you could make some assumptions about what type of return you would likely get over, let's say, a 25-year period, and that would give you a really good estimate of how much wealth you would likely build. You can see here we've got a 2, 4, 6, 8, 10% returns, what they would do over that 25-year period. You could even calculate pretty easily how much wealth you would build up after paying fees. Here are hypothetical examples of how much wealth would have been built with a $1 million investment from 1966 to 1990 with a 50-50 allocation of stocks and bonds. Please make note the difference in wealth between a 1.5% fee, where you ended up with $5,666,874, versus a 0.5% fee, and you ended up with $7,154,530. That's $1,487,656 less, 26.25% lower, by just paying 1% in additional fees. The key finding you won't hear from a majority of financial pros is this: fees are big wealth grabbers. They steal your wealth. Only a 1% fee grabbed $1,487,656 of your wealth over 25 years. Imagine the damage fees can do to your wealth when you're taking retirement income from your accounts, especially in years when the market is down. When you flip the script from accumulation to distribution, so building wealth to spending it, you find that the distribution phase is not linear, where what you put in is not proportional to what you get. Sandage calls this chaos theory. And here's an example of how different the distribution phase, income phase of retirement planning is. So we've got two different income examples here, hypothetical ones, with assuming $1 million in a portfolio of 50-50 stock bond allocation, taking a 5% withdrawal, so $50,000 a year, and we're going to increase that 3% annually for inflation. From 1965 to 1989, the red bars shown here, the average return was 9.3%. And after 25 years, the $1 million has dropped to $79,192. Whereas from 1950 to 1974, the blue line shows a 7.2% average return. And after 25 years of income, it still has a balance of $1,038,862. So during the accumulation period, anytime you have an average return of 9.3%, you know you would have more wealth than if you had an average return of 7.2%. That's that linear relationship in accumulation that does not exist during the distribution or income stage. So your takeaway from this should be you absolutely cannot use the same strategies that you use to build wealth in the accumulation stage to take income in the distribution stage of retirement. So here's the question: is now the time to see where your retirement stands by getting your free retirement success score, and then see how our volatility buffer strategies combat the unknowns of the market, the ups and downs. If you think it is time to get your free retirement success score and sample our volatility buffer strategies, go to www.bookkurtnow.com and click on the 30-minute discovery call option to find a time on my calendar for us to have a conversation. Look forward to speaking with you then.